Good afternoon, everyone. Good afternoon, ladies and gentlemen. So, first of all, I'd like to apologize that we're a few minutes behind schedule. As some of you are aware, if you were here earlier, we had a press conference that ran into this time now. I can see that some of us are still eating from the coffee break. I'll give us a few, say like 1 or 2 minutes, to just rush off so that we can please sit down and coordinate for the beginning of the actual launch of Duo. And please, pardon guys that are working. We had a bit of a movie earlier where we launched and unveiled our logo, and so we need to clear up all of the aftermath of that. My name is Onomel Mokoro. I'm the team lead marketing and corporate communications for Mixta Africa, and I will be your host for this afternoon. I'd like to thank everyone for taking out the time. I understand that it's a busy day, it's a busy week, and it's especially a Tuesday, a work day. So for taking out time to attend today's event, we're very pleased and we welcome you. Like I said, I'm just trying to give people 1 or 2 minutes to round up with their eating. And if you are done eating, please, if you could just move forward. For the sake of the cameras and recording, we are streaming live. So it'll be nice to have a bit of a crowd in front. So, yes, I'm looking at you. Please move forward. Hi, ladies at the back. Very pretty ladies. Can we please see you in front? Thank you. Please move forward. Recorder, I understand that you're recording. You can record from the front. It's okay. Please move forward. Thank you, SARS. The first 3 rows, please, so that we just fill it to the back. Thank you. We already have some of our speakers around. I'd like to say welcome. We'll be introducing them as the time goes on. We have members of management of Mixta Africa and ARM here as well. Thank you very much for taking out time. We appreciate you. And we have some staff members of Mixta Africa here too. Thank you very much for taking out time. All right. Okay, so I think we can start now. I think most people are done eating. I still see a few empty chairs in front. I will please implore you to please move forward, move forward. I've said please twice in one sentence. That's to show you that I need you to move forward, please, again. Please move forward to fill the front row. Thank you so much. Okay, without wasting any more of our time, I'm going to sort of declare the event open. We're going to be inviting our CEO, the CEO of Mixta Africa, to give us the welcome speech. He's the one welcoming us to today's event, and he's going to be speaking to us, just basically welcoming us to Mixta Africa's event and launch of the Duo. It's fine here. Thank you. Yes, sir. Thank you very much, sir. Please give him a round of applause. Mr. Deji Ali.
Yeah. Good afternoon, ladies and gentlemen. I think I will just say a few words to support some of the important contributions that have been made earlier by some of my colleagues. I should also say a big thank you to Mr. Akim Ogonero for accepting to be the keynote address speaker. We look forward to exciting things that you have to share with us. So thank you very much for accepting the invitation. I think the few things I would like to say relate to Nigeria as a whole and how it is that the sort of challenges that we have across every aspect of our lives in Nigeria is similar to what we're encountering in the real estate sector. The reality is that the scale of the challenge that we face is so huge that nothing we do as a company can begin to dent or provide a solution towards curing that problem. And so I like the context of the keynote address, which speaks to a larger picture. We all know that without reforms, such as we've seen in the pension industry or in the telecommunications industry, we will not have an enduring solution, especially for the demand side of the real estate sector. And so what we need to continue to do is to engage government to take reforms a lot more seriously. And when I say reform, I don't mean it in the context of looking to government to provide funding. We just need to ensure that so many agencies that have been set up already in existence, such as the Federal Mortgage Bank, the Family Homes Fund, what the Federal Ministry of Works and Housing is doing, and even what the CBN is attempting to do in the real estate sector, have connectivity in such a way that we can propel growth that we like to see in this sector. I mean, government did not put in money in the pension industry to create the multi-trillion naira opportunity that we all see today. And I think that's exactly what needs to happen. Now, the reality is that when you speak to people in the public sector, there's an orientation that, you know, makes you get the feeling that we believe it's about government providing funding, and that if government is able to provide funding, it means that the solutions would have been created. We think that the solutions that worked well in the 70s in Nigeria, whereby the federal government, the Lagos state government, and other forward-looking state governments provided the supply of accommodation and also encouraged demand by creating agencies that provided mortgages, will not work in today's environment. And that's because the government's fiscal position is so poor, they can't begin to look in that direction. And so what participants or players in the private sector need to continue to do is to engage government, to encourage government to do those things that are necessary so that we can make the connections between some of the opportunities that we have through agencies that are already in establishment. Of course, as a real estate developer, whilst all this is going on, we have to find ways to earn a living, to sell our homes, and also encourage our customers or clients to buy those homes. So what we're doing in the rent-to-own scheme space is just one of the several initiatives that are necessary to generate the demand. But it's not sufficient on its own, given the deficit that we're talking about in the country. And I hope that the contributions that will be made by the panelists today and also Mr. Oguniro will speak to how we begin to address the larger problem in such a way that we can create a conducive and sustainable solution for curing the demand side problems that we have in Nigeria today. We as a company will continue to be creative and innovative in preferring solutions in ways that would assist us to encourage our customers to buy homes. I think the rent-to-own scheme is an innovative solution. It's relevant. And I think when we talk about affordability to us is not speaking about low-income people. Affordability means that whether you're high-income person or low-income person, it speaks to the capacity of your cash flow to service obligations involving the acquisition of real estate. Now, if financial intermediation was also very poor in most of the developed countries, such as the UK, the US, then the home ownership rate will be very low. And that's about affordability. So financial intermediation and creating channels for everyone, whether you're on grade 3 or grade 15, to be able to plug into a cash flow that allows you to service obligations relating to home acquisition is what we think is necessary, and will create that opportunity for everyone aspiration as far as home ownership to manifest. So thank you once again for granting us the opportunity to speak to you today. And I wish the panelists and our keynote speaker an enjoyable time as they're introduced by Onome. Is it you that would be doing that? Thank you very much.
Thank you very much, sir. All right, thank you very much. We'll be going to the next segment, where, as you have seen, Duo is what we're talking about today and is why we're here. The CEO has already sort of spoken to why we have what we call Duo, the rent-to-own scheme, and what it's set to solve, the problems it's set to solve. So to take us further into what Duo is and the solution is supposed to solve, and the problem is supposed to solve, excuse me, and all that it is, I'm going to invite the product manager for Duo Rent-to-Own Scheme Mixta Africa in the person of Boyinde Agboyinde. Please give her a round of applause.
Good morning, everyone, and welcome to the official launch of Duo. Yes, someone said I should breathe and just talk. So I'll say the same thing to you, breathe and just listen. So one of my best pictures of Duo, like I always say, is the one that we have on this slide. The next page, please. Yes, this particular one. So of all the advertisement of Duo, I think this is the one that kind of like speaks to me about the entire product. You know how it is, it says Duo, that means two. If I ask you, what comes to mind when you hear Duo? It means two. So Duo offers you having to rent today and having to become a homeowner tomorrow. You know, that's quite key for somebody of my age, that, okay, I can rent a particular apartment and own it tomorrow. That's like the head and tail of the entire product. So how exactly can you be a homeowner? You know, when Mixta looked at it, we said we don't just want to build homes, we want to build communities. We don't just want to be the foremost developer, but we want to make impact, not just in the life of luxury or high-end earners, but also in the life of affordable earners and other segments, mid-markets. So we thought about it, that what other initiatives can we actually introduce, other than mortgage, other than HSF, other than financing and the likes? How exactly can we reach out to other segments, other sectors in the affordable circle? And then we came up with this, that's the rent-to-own scheme. We thought of it that if you then, okay, if we try this particular scheme out for a period of 3 years, if you rent for a 3 year, then after third year, you have saved up. If you're a serious person, by the way, you would have saved up probably through mortgage, through acquiring loan, through the RSA, or even merging the RSA as well as the mortgage together to actually have your final fund or the property contribution at the end of the maximum rental period. So that's the entire process of the rent-to-own scheme. The next slide. So, yes, the next slide kind of shows like a journey of what Mixta actually entail to achieve. I'm sure it is very blurry. I'm sorry, you might not be able to see it clearly. But it starts from how exactly can a subscriber acquire Duo. The first thing a subscriber then needs is 5% of the equity contribution, or 5% as the equity contribution. We had a press conference today where a particular question was asked, that what does the subscriber need to do, or what is the cost implicit to that particular subscriber? And we looked at it that, given the current state of the economy, what exactly is very beneficial to be the entry value of this property? Having known that we are not just delivering any property, but we're delivering a fully finished property with 24/7 service, great infrastructure, you know, a lifestyle that so many people feel like it's very far-reached. We're providing all this at a sum currently of 3 million. And what does the subscriber need to do today? All the person needs to do is to make an equity contribution of 1.5%. That's 5% of this particular product. I would say in my mind that it's quite interesting because today, let me not say everyone, but most people can sit down and walk through providing 1.5 in 12 months. So if an average rent for today, even in the mainland or anywhere, is ranging from the likes of 700 to 1.5. So if I can pay that rent in any particular year, that means I can do the same, pay it consistently for 3 years and own that property. I think it's a win-win on our end and for any subscriber. And that's what Duo is doing. Afterwards, if you do that for 3 years, on the 4th year or at the end of the 3rd year, you had already built up your sum, and which would then acquire the value. Then someone asked me when I was talking when I took some people to site to actually look at the product of the Marula, how exactly then does Mixta gain or benefit from this particular product? Yes, we want to provide impact, but at the end of the day, we also want to have return. So on that, say annual fee, we put, or the entry fee, we put 15% interest on it, just to gain or to determine the price of the property at the end of the rental period. Someone said, why 15%? How exactly did we arrive at that? We know that, yes, our inflation rate continuously increases, not just in Nigeria, but globally. We know that our interest rate is also going high. We also looked at it, that what rates can any given person acquire a loan finance from the bank? Considering all that, Mixta thought of it that, I think 15% is quite generous on any given value today to make up the sum in any final year. So yes, that's the story of Duo. After the 3rd year, voila, you become a homeowner. And I would say there are different financial initiatives that Mixta has actually brought to the limelight. As far back as 2019, it introduced Mixta Flex, which was a great success. It continued with Housing Solution Fund, moved on to Duo now, and who knows, by tomorrow, it can actually bring up many more solutions our way. So with that, I would say the next slide shows us what exactly is the value proposition, or why Duo exactly. Duo is flexible. Would anybody disagree with me? Well, I'm sure you wouldn't even want to raise your hand. Duo is quite flexible. Yes, it is. It allows you to lock in the value, to get in a contract today and be assured that in 3 years' time, it's that same amount that you've locked in that you get to pay. No discussions, no problem. And if you work with a company or if you partner with a company like Mixta, you're well assured that you would get value for the money that you've placed down. The next for us is a good exit option. One of our senior management talked about the fact that this product actually gives you the opportunity to, whether you want to buy or you don't want to buy, you have that option to make. So at the end of the day, it gives you that good exit option to become a homeowner or to decide to take your money and do something else. At it all, we say it's a reasonable rental yield for those that then decide that they want to become investors using the Duo product. So then, I'm sure in your mind you'll be saying, why Duo? But I'm sure when you think within, you would appreciate the product itself. With that, I'll say thank you once again for coming for our session. We'll be having the panel session afterwards. Thank you.
Thank you very much, Boinde. That was very quick and concise. I'm almost led to ask if people have questions, because I feel like there was a lot that was left unsaid. But yeah, if you have questions, you can still, I think we'll take question and answer towards the end of the event. Before Boinde spoke, she said something that I'm going to now take in, breathe, because clearly I haven't. Okay, so next we're inviting our keynote speaker, and I have let me show you his profile. This is how long his profile is, so I don't even know. I'm going to be I can't read everything, of course, but this is just to show you how accomplished our keynote speaker is. So I'm just going to say a few things, and I hope I do justice to who he is and all that he has achieved. Mr. Hakeem Oguniro is the founder and chief executive officer of Eximia Realty Co. and Mercury Nominees Investment Co. Limited. He's also the non-executive chairman of the board of directors of Lagos Building Investment Co. PLC and a few other companies. He's a thought leader on African real estate structuring, funding and delivery, and has been described as having a unique standing of the connection between financial models, capital markets, brick and mortar, all within the context of Africa's complex and challenging operating environment. He's a member of the National Association of Real Estate Investment Trusts, the worldwide representative voice for REITs, and listed real estate companies. He's an executive committee member of the Nigerian British Chamber of Commerce and the Institute of Chartered Secretaries and Administrators of Nigeria. He's an ordained reverend of the, so I'm going to go a bit personal because he has a lot that he has achieved. So he's an ordained reverend of the Foursquare Gospel Church in Nigeria, happily married to Professor Yabode Oguniro, a professor of law at the University of Lagos, and they are blessed with 3 lovely children. Like I said, I'm not sure I could have done enough justice if we did not want to stay here for long. So please join me in welcoming Mr. Hakeem Oguniro on stage.
I'm also going to breathe. So I'll breathe and I'll then speak. I think it's afternoon already. Okay, good afternoon, everybody. I'm very pleased to be here to share my keynote thoughts on this occasion. So I'd like to thank Mixstar for inviting me. Like I was telling them at the gate that Deji and I date way back. In fact, in a way, it's my in-law. You guys don't know. Because, okay, let's leave that part of the story. But I think the last time we saw was in Spain, Sardinia. I remember at that wedding, that's like 4 or 5 years ago. Everybody came back and we've all been very busy, you know. And also just to appreciate everybody again. BT, since the time I married your wife for you, you have run away. You know. Okay, do I have the slide? Okay, I was asked to speak on financing opportunities for home ownership in Nigeria. But I tried to look at the topic in the context of the overall theme of this event, which is broadly looking at the environment, the economy, and everything. So I took the liberty of being the speaker to change the topic to housing finance and home ownership in Nigeria for 2 reasons. If you look at the housing finance ecosystem, there are 2 pillars. There's the asset creation side, and there's the asset acquisition side. And both sides require financing. And in fact, most of the times, what happens at the financing of the asset creation side has significant impact on the asset acquisition side. You know, so what I'm going to be doing is to briefly look at, in my opening thoughts, share around some issues around the real estate industry generally, real estate and the economy. You know, there's a whole lot of issues around the future of real estate now post-COVID. So I just share a brief thoughts around that. Then I'll look at housing finance. What are the current options for housing finance? And what is the future of housing finance? What are those areas that we must pay attention to if we must survive? I mean, and they just so eloquently laid all the issues around the table. We operate in a very volatile economy. You know, the Americans coined the term VUCA, volatility, uncertainty, complexity, and ambiguity. And I used to say that maybe they had Nigeria in mind. They had Nigerian business environment in mind, because if you're looking at a volatile economy, is there complex, uncertain, you know, and all the issues around us. You know, so it's a very difficult space to do any business. You know, I always say that doing real estate is needlessly painful, you know, but that's another part of the story. So if I have my outline, please. You know, so in the opening thoughts, briefly, it's important that we look at the current drivers of the entire market. I'll look briefly at the nexus with the economy. Recently, I've been looking at the framework for the future of real estate by BCG and World Economic Forum. So I'll just say something briefly about that. I'll look at the socio-economic drivers of housing finance. What are the pull factors? You know, because I always say that, see, capital is very, very rational. capital is rational, you can always predict how capital will travel. So if you want to pull capital to housing, there are some factors that you must take into account. I always talk about the 3 big R's: risk, return, and regulation. Now, I look at briefly the current and the future trends. And I say the future is now, because as players in this segment, clearly there are some innovative financing frameworks we need to pay attention to. So I'll look at green finance, crowdfunding, non-interest financing, in particular, Sukuk. You'll see what has happened to Sukuk recently. I'll look at asset unitization, real estate investment trust, which is my special area. I also look at asset tokenization, which happens heavily now. Then I'll look in home ownership financing. I think it's always important that we look at the issues. What are the issues that impede home ownership financing? What are the current options? Then I'll look at briefly the I think presents significant opportunities. Mortgage to GDP here is still less than 1%. In some countries as high as 70, 80%, So I hear there are just about 22,000 mortgages in Nigeria, in a country of 200 million. So there are significant opportunities in that respect. Because I look at fractional ownerships, and not just fractional ownerships in terms of asset tokenization. In Europe, fractional ownership is very common. So if you are buying a 1-bedroom flat, you could buy the room and rent the parlor and the remaining and be paying rent on the rest of the apartment for a few years until you have money to buy the remaining. So all those innovative, and I was surprised in UAE that last year they had to introduce a law on fractional ownerships. And I think it's because they understand that fractional titles is also going to be very critical going forward. If I can have the next slide. Next slide, please. Okay, so like I said, we need to pay attention to drivers of change. Urbanization, obviously, is a critical element driving change. We're told by 2050, 7 out of 10 people, in fact, in Nigeria, they say 8 out of 10 people, everybody wants to live in the urban cities. So that presents significant challenge for housing and the living segment. Post-COVID-19, we're still at the odds and pains of COVID-19, new ways of living, new ways of working. Remote work is still reshaping the market dynamics, and so many. And particularly, our industry will face significant competition from other asset classes. So today, as an investor, if I have money, I want to invest, I'll look at real estate. I'll also look at other asset classes. I'll look at the yield. I'll look at the return. These are the days of cryptos and other investment that can easily be scaled, unfortunately. Real estate is generally an illiquid business. So today, people focus on assets that can be turned around immediately. Next slide, please. Now, I'm just going to say, and there's a strong nexus between real estate and the economy. I always say that everything happens on land. Everything happens on the land. We're here. The hotel we are in has been built on. So it's all about real estate at the end of the day. I always tell the guys in IT, the digital people, that even the cloud, iCloud, the cloud lives on the ground, inside data centers. Data centers are real estate. I always tell them that you can do anything you like in the metaverse. I hear somebody's already building a metaverse church in Nigeria. You can go to church service in the metaverse. You can do wedding in the metaverse. You can do business in the metaverse. You still have to return to sleep in a physical house wherever you go. That underscores the significance of land and real estate. And that, I think, is the significant point that I'm trying to. So real estate drives everything. And if you want to know how any economy is doing, just look at the housing segment. Look at how many houses are being built. And any smart government understands that, once you trigger the housing segment, you trigger the economy. Just imagine what happens when you are building just 2 or 3 houses. Immediately a market evolves around. There's a market of food sellers, of vendors and things like that. These are the critical components of the economy that we need to pay attention to. Next slide, please. Now, this slide, the World Economic Forum and Boston Consulting Group, they've been talking about the pillars of the future of real estate, and if you look at the 4 pillars, livability, resilience, sustainability, affordability, they all speak to financing. And that is very critical for me, because at the end of the day, it's about what drives the finance at the home ownership end. Next slide. So, it's critical that we also understand that there are factors beyond financial factors that drive, real estate, housing will always thrive off the back of strong macro fundamentals. If the economy is good, real estate will do very well. If the economy is bad, real estate will struggle. So what are all those factors? Inflation, interest rate. Recently CBN, in its normal wisdom, move MPR by 100 basis points again, 15.5 to 16.5%. That means, I know the way the banks behave, automatically interest rates go up. I understand that average interest rate now for a lot of borrowers is between 30 and 40%. And I used to wonder, how do you borrow at 30%, at 40% to do real estate? So I used to joke that these guys who are borrowing at 40%, let's go and investigate them. Or maybe they're also doing kidnapping with the real estate that they are doing. I don't see how you borrow at 30, 40% and still survive in this. What's your margin? Margin, Exchange rates, our inputs. All the inputs in the industry, 80% of our inputs are imported. So anything that happens to supply chain globally, China is the supply chain capital of the world. About 50% of our input either have one thing or the other to do with China. So when they breathe, we catch cold. Social political factors, insecurity, for most people, investment in a house is the single largest investment they will make in their entire lifetime. They don't want to make that investment when there is kidnapping, killing people and things like that. They want to make it when their head is settled, So sometimes people don't understand, people can't really see the link between all these factors and housing, but those links are really very, very significant. Okay, I need to move a bit fast because I have just 20 minutes. So let's go on. Now, this slide is very, very important for me because what is the crux of the matter? The crux of the matter is that you cannot use short-term funding to finance medium to long-term projects. Typical gestation period of your project is 12 months to 48, sometimes 56 months. So this is not something you can be financing with 33 months money and things, which I see a lot of people doing, And I always say that at the end of the day, this is a financing game because you have to be able to match your assets and liabilities optimally on a sustainable basis. If you can't do that, you are back in your village doing something else, certainly not real estate. So, financing the gap requires special medium to long-term financing, and I think that accessing large-scale capital depends on how we're able to create, and that's part of the message, which I bring here today. Pension fund is now like 14, 15 trillion naira now. If you look at whenever I want to exert myself, I will go to the website and see the allocation of funding. Government has an overreaching effect. Government borrows like 80-something%. Infrastructure and housing and REITs and everything is less than 2%. And I always say that we need to get to a level that we're able to create assets that we just access 5% of 15 or 14 trillion. All the grammar that we are borrowing, all our pains in this industry will just go. But we have to get to that level. Next slide, please. Now, housing finance is driven by 3 R's: risk, return, and regulation. Unfortunately, these 3 R's in a whole lot of ways. So risk, for housing, the person who is financing you is looking at all the risk, development risk, uncertainty of title. I mean, I can speak on title uncertainty for the whole day, You see what has happened in Magodo, what has happened in Iwaya, what has happened in Agidingbi recently. There's a judgment in Agidingbi affecting over 1,200 houses. What do you do? You know, so as an investor, if I can put my money in TB and earn 18-20%, why will I risk my money in any project that you have to deal with Omonile, deal with agents, deal with all the last far, last car, last, you know all the last RIA, all of them, you know. So, and then return. How competitive? How competitive? Because you are competing against other asset classes and regulation of. Next slide, please. I'm just going to skip all this, and then I will just talk generally to like the next 5 slides, and I'll go to my last 2 slides. You know, I'm sure we know a whole lot of these traditional models. You either do debt equity. We know this, at least in Mixta. I know that you guys know this one very, very well. So, next slide, please. But I've always said that money market is unsuitable for real estate. That's the message I've preached since the beginning of Real Estate Unite. You know, I've preached that money market is unsuitable for housing finance. The tenors are too short. They are incompatible with the nature of projects. The interest rates are usually too high. The securitization process is complex, cumbersome, it's expensive. There was a time I did a project in my previous life when I was at UPDC. You know, we did a project. What was the value of the project? I think 9 billion. You know, and the documentation for the facility. You know, we signed over 50 agreements. So that itself was a full-time job. Full-time job, over 50 agreements. You know, you can't imagine. You know, so at a stage, it became like a documentation framework, you know. And when you borrow from money market, you are susceptible to macro volatilities. Anything changes, it is changed. Usually there's a variable interest rate in your letter. And people don't know that there's a Supreme Court decision, Union Bank and Ozigi, you know, which has given a seal to once there is a change, the bank is automatically entitled to also change. On the other hand, capital market is supposed to be the pillar. It's supposed to be the medium where capital owners bring money for capital users to access. You know, so you can guarantee source of funds at a fixed price, access to a much larger pool of investors. You can be creative in your financial instruments. You know, I mean, I've done a few things in the past that are off the book. You know, that we basically sat down with the advisors and we've created instruments. You know, so. And funding through the capital market enables you to match your assets and liabilities. And I think that's where we really need to go as a nation, you know. We can go round and round and round, you know, but we have to develop a capital market and create that nexus with the real estate and the housing segment so that we can access it a lot easily. Next slide. I'll just leave all this. They're all in the presentation. Next slide, please. Next slide, I can leave all this. You know, so I mentioned at the beginning, what are the areas that we need to pay attention to, you know, in terms of the future? Of course, non-interest finance is very critical today, you know, and just look at this as ethical investing. What has happened all over the world, there's a whole body of ethical investors. And you can see from all the sukuks that federal government has issued, you know, 1, 2, 3, 4 sukuk. Always 200, 300% oversubscribed. Last year, Family Homes Fund issued an Ijara, you know, 2-year balance that they put behind it, you know, over 200% oversubscribed, you know. So non-interest finance, ethical financing is critical, you know. Next, I thought my time was up. Of course, asset unitization, you know. I've done a whole lot of work on REITs, and there's a whole lot of reform. You know, when we floated the UPDC REIT in 2013, the law was very, 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 very strenuous. Tax was an issue, you know, because a REIT is supposed to be a transparent flow-through investment vehicle, you know, because if the instrument does not enable you, if you pay a tax both at the entity level and at the unit level, it's double taxation. For a long time, it was difficult for the regulators to understand. And we had to do a whole lot of advocacy. But eventually they understood. By the Finance Act 2020, they've created a proper regime for it. It's still an issue because we still don't have, you still can't do development rates. You can only do investment rates, which I think is stupid really, because you have to create the assets. If you don't create assets, how do you do investment rates? But we have a framework now that allows you, particularly if you already have assets, you can put your assets together, create a vehicle, and sell part of it. So that I think is a major area that we need to look at. Next. And I think Purple is in the market now, along this line. And I think it's good for the market. Next slide, please. We need also to pay attention to, of course, this is the era of digital. So there's a strong link between REITs and tokenized assets, because REITs enable you to unitize. When you unitize, you put it on the blockchain technology, and you have access. And there are two products coming into this market now. I'm involved in advisory capacity in one major project now, which I think is also going to test the market and see where we are going. But clearly, going into the future, we have to pay attention to digital. Next. The other major issue, next slide, please. Of course, green financing, it's a no-brainer that, I sit on the board in the UK now, REAL. I sit on the board of REAL, and I was surprised that from day one, everything has been about climate smart, climate smart, climate smart, climate smart, climate. In fact, when I was doing my induction, there was so much issue around climate smartness that it was like they sent me back to school. And with the outcome of COP27 now, it is clear that in the future, you hardly will be able to access large-scale fund unless you have very strong green credentials in your project. So we need to pay attention from the time of design. So we are about to launch a project now, and we are paying particular attention, to the issue of green, especially if you want to access large-scale fund. Next slide. So I think, of course, crowdfunding, the legal framework was approved last year. Even under the law now, you can only raise 100 million naira, which cannot even buy you a quarter of a plot in Oniru. But I think that the advocacy has paid off. Finally, SEC has recognized that we need to put a framework around this, and I think it's only going to grow going into the future. So let me go to my last two slides, please, and just close this. Next slide, please. Okay, so home ownership. What are the issues and what are the options? Home ownership finance. I think issues number one for me is availability, because people don't understand that the absorption capacity of this market is very limited. If you put 10,000 houses in Lagos, now who's going to buy them? Who is going to buy? Which is why a product like rent-to-own, like Duo, is very critical. Because the absorption capacity of this market is very, very limited. In 2018, I went to attend a REIT conference in New York, and there was a fireside chat. I always like to tell this story with Sam Zell. Many of us who know Sam Zell. He's one of the biggest real estate entrepreneurs globally. So there was a fireside chat with him on the stage. This was 2018. And they asked him, how was business in 2017? And he said, well, they didn't do very well in 2017 because they only managed to add 527,000 units to their stock. One company, 1 year. And I look at all of us in Nigeria, put all of us together, add everybody. I'm not sure we do 5,000 units per year, per annum. And part of the challenge also is that the absorption capacity is very, very limited. So availability, inflation rate, say too much about that. The financing process, the perfection process, the lawyers know all the issues around perfection, consent, with all the advocacy that we have made, it's still a major, major problem. Income levels. There was a time I spoke for APBN, and I did a simple analysis that, if you use the United Nations standard for affordability, for a 5 million naira house, it will take 62 years to repay the capital cost of the house. I'm not sure anybody has that kind of patient capital anywhere in the world. You know, so the income, so we are also a poor country. People, you know, we like to just deceive ourselves. You know, we look at our parties and all the gidly and all the music, you know. We are fundamentally and essentially a poor country because of the low, and now with unemployment and everything is a major problem. So what are the current options? You could do self-financing. Of course, you could do cash purchase, which people do, particularly in the luxury segment. You know, that's the only segment that appears to be resilient, because those who buy in that segment, they already have their money. They're either buying a third, fourth, or fifth house. They don't borrow. They don't rely on duo. They don't do mortgage. You know, I'm not sure whether you noticed that building that collapsed in Ikoyi, the guys who went to court, they had deposited 15 billion naira with the developer. If you add the 9 of them, that's not all the subscribers, though. But if you add the 9 people that went to court, I took my time, I added all the money that they have paid to this developer. 15 billion naira, you know, in that segment. To do off-take, installmental payments, of course, you could bank assisted, commercial loans. A lot of the time, what we call mortgage is commercial loans. I mean, I've taken commercial loans in the past when I was growing, because if you take a loan, the bank calls it a mortgage, maximum is 2 to 3 years at that time. You know, the rate is 20-something%, you know. So you could do commercial loans. Of course, you could do mortgages. You could do National Housing Fund, which is supposed to be the best of them all. But of course, you guys know that first of all, I think the maximum amount is too low, and the process is unfriendly. Of course, and you could also do developers financing. So finally, what I think are the opportunities that we can look at, you know, at least based on what happens in other parts of the world, and some of these things are also already happening here in Nigeria. Like I said, there's a major opportunity in the mortgage system. Today, mortgage is less than 1% of GDP. It's less than 1% of total bank assets. I try to compare with South Africa. It's 23%, Tunisia is 11%. Other economies, it's about 50%. You know, so when you have an economy where mortgage is less than 1%, you know, of GDP, it's a major issue. Of course, there's opportunity now with pension reform. You know, now you know that recently the guideline, PENCOM issued a guideline that if you're an active contributor, you could use 25% of your RSA for your residential mortgage. So there's a major opportunity that I believe we can look at. There's support for co-ownership. There's a lot of co-ownership and co-living going on now. In fact, if you know what guys do now in Ikoyi, they just rent a house. 8-10 people, they rent a house, all of them, they live in the house. So I'm beginning to think there's a major opportunity in that respect. Cooperative financing, this is one area that we've made so much noise about cooperatives, but we've not done really well. In Kenya, SACCOs, for every 10 houses that were sold, the cooperatives financed 8 of them. The cooperatives are even bigger than the banks. They're bigger than the banks. I heard that today, banks are queuing to key into the cooperative system in Kenya. You know, but there's a whole lot of issues around the whole framework. You know, I mean, I started a cooperative. You know, but you know, here you can't really do a real estate cooperative. We had to insist that I don't want to do Aladesheku, buy oil. I said, I started this cooperative because of trying to create a platform for real estate financing, you know. And of course, we've been working with Lagos State to introduce the new set of rules, which will come out very, very soon, you know. So you could do invest to home ownership. You could invest with the developer. It turns around your money until the money is enough to buy a home. You could do fractional ownerships, where property is split among a group of owners. And you can also do fractional titles, like I said at the beginning. Buy a portion of the house, rent, and these are models which have been tested and they've worked in other parts of the world. And of course, I think I love rent to own because rent to own is like a hybrid of mortgage and normal home ownership. And I think that this is one of the products that whoever gets it right first, and there are a lot of people have come into the market with rent to own. I've done rent to own with an organization before. We ended up in the market, in the courts, What this does is that it enhances the capacity of buyers. And I think the message, I think the positioning has to be excellent. The positioning is that rather than pay rent, you can, because the way it works is that the whole of your rent can go into part of the purchase price, or a part of your rent can go into part of the purchase price. I think that if that positioning is well articulated in the market, I think it's going to really drive home ownership in the market. Thank you very much. That's my story.
Thank you so much, Mr. Hakim. Thank you to our guests for listening to the keynote speaker. I'm sure that you've learned one or two things and you've been able to pinpoint notes. Up next to be our panel session. We'll be having guests, and then afterwards we'll be having question and answers. I'm sure for so many of us we might have questions that we would like to ask. Without further ado, I would be introducing our panelists. The first on our list is Mr. Oladapo Rusewa. He is a project and city report lead at City Intel. He had done quite a lot of research in affordable housing. He's in charge of providing data and research support for real estate investors, and has one or two things to say about Duo, very key. He's a member of the Nigerian Institute of Estate Surveyors. You're welcome, Mr. Dapo. Please, a round of applause. Next on our list is Tosin Ajose. She's a business lawyer with over a decade of experience. She is a partner and the lead advisor at Lead HQ Partners. She has done extensive policy work in financial services space, the first as a legal enabler under the Central Bank of Nigeria FSS 2020 initiative. Please, a round of applause for her. Our next panelist is Babatunde Davids. He's the Vice President with the Real Estate Finance team of Stanbic IBTC Capital Limited. He has over 14 years of experience that spans across structured finance, project finance, equity capital markets, and property investment. His focus on real estate include offices, real estate, residential real estate, portfolio debt, and the likes. Please, a round of applause for him. And finally, on our list of panelists, we have our Chief Commercial Officer of Mixta Africa, in person of Rolake Akinkube Filani. She has interest enough in finance, energy, and investments. She has had experience in that particular circle and has a lot of clients around that. Other than that, Rolake is an executive of the Mixta operating subsidiary in Senegal and Cote d'Ivoire. Round of applause, please. Thank you. Please, can anybody help with this? Yes, good afternoon, everybody. A mic, please, an extra mic. Thank you once again for accepting our invitation for Duo. Before we dive into Duo, we have different experts from different fields, and yes, we chose them on purpose. We chose partners from the research team. We chose a lawyer to understand the operations exactly of Duo and what we're diving into. we chose somebody from the real estate financing aspect to look into other financing initiatives that most people might have been contributing to. And finally, we chose our Chief Commercial Strategy, who better, and Mixta Africa. Thank you. Please, a round of applause for all of them, please. I'll start with Mr. Dapo. We have our first question. And just remember, like I said, you guys are experts anyway. I'm the learner on this place. It says breathe. Yes. The first question is, the inflation cancer currently ravaging the country is of no doubt negative impact. I don't know if you have any comments on that as regards the economic sector of country Nigeria and the real estate industry.
Okay. So I think inflation has really hit the country. I think year on year, inflation rate is nearing about 17%, going by the last MBS statistics released. So that has drastically reduced purchasing power of lots of Nigerians. And as everyone knows, we are basically the poverty capital of Nigeria. So with regards to real estate, it has made access to funding a whole lot more difficult recently. Developers can't get capital to start their developments. Willing buyers have seen their purchasing power reduced, so that affects what they can purchase and what would have preferred. They'll have to go for cheaper options because of that. So generally, I think while we kind of hope for recovery, let's say from next year, currently it's been a hard time. Like Mr. Hakim said earlier, developers are being forced to take loans of 30–40% just to put up stuff, and who knows what their margins are. But once we can get down that control, hopefully we can see a reversal of that.
Fantastic, thank you very much. I would also like insights from Mr. Babatunde, Mr. Babatope rather. Yes.
Thank you. So inflation is a reality in our current environment. It's been a reality for some time now. So the inflation is there. Anybody who is playing in any sector in Nigeria must factor that in. The good news is that real estate across the world is reckoned to be, over time, of course, over the long tenure, as one of those investment assets that is able to provide some edge against the inflation. And there's also the positive effect that, okay, fine, whichever way the economy is going, if we are going to make anything good out of Nigeria's economy, we ultimately need to pay attention to what's happening in real estate, because you want to fix healthcare sector, healthcare needs real estate. You want to fix education, education needs real estate. Any part of the economy or the other. So it's important for us to look at what's happening. Inflation is in there. How does it impact the guys who are responsible for the supply and for the demand of real estate? On the supply side, they are hit by, sometimes it shows up ultimately as cost overruns, because the building prices go beyond what they are looking for. It's their margins over time before you know what's happening. And of course, that brings uncertainties that investors and financiers will be interested in unpacking. And for the demand side as well, from their everyday living, their disposable income is already hit by inflation. So again, it's also eating what can they afford from their side. So I believe that the cult, like I mentioned to all of us, like I mentioned earlier, deflation is going to be here. And the CBN is doing its best to curb it, but inflation is here for a while. So while we are doing that, what then do we do? I think from all participants in real estate industry need to constantly be creative around, okay, fine, how do we finance the developments of this real estate, and also how do we provide opportunities, provide structuring solutions that would enable even the buyers as well to be able to participate. So all of these will be development financing, careful thinking around development financing, careful thinking around, okay, with mortgages, and all the other solutions to support the financial purchases.
Yes, thank you so much, Mr. Babachokwe. And one key thing I heard is you saying people need to then, or developers then need to be creative. As such, I'll go to my next question to Tosin. With recent happenings on alternative real estate financing means, how would you rate investors' confidence in Nigeria, and especially with the success of rent to own, from a legal view?
Good afternoon, everyone, and thank you again for the very kind invitation. So I'd say that I've been monitoring the rent-to-own market for almost about 10 years in Nigeria, and to give insights, I can tell you easily that over the last 10 years, the market has made a lot of effort to democratize financing the buy side, because all of us know the inherent issues, that play out in the market in terms of being able to finance people that need housing, particularly on the residential side. So for over 10 years, a lot of people have been trying to bring a product that works to the rent-to-own side of the market. So what would I say we have seen? There is a need. We have a very huge, proportion of people that are trying to acquire homes. But we have a market where, like Mr. Oguniro said, we have access to short-term funding, and we know the reason why. Real estate is an asset that is competing with several other, asset classes for funding. And if we cannot match the returns that these other instruments are able to, deliver, then we have a problem. So returns is one issue, and then we also talk about risk. I'm happy he also mentioned that government is one of the biggest borrowers, in our money market, in our capital market, and other, all the other, sectors of the market that provide financing. This poses a significant issue to, access to funding. So now where we find ourselves that a lot of people are looking for creative ways that they can bring products to the market that impact, the buy side. And I'm very happy that, people like Mixta are coming to market with a product that allows, people to, access financing and pay for, real estate property over a period. From a consumer side, what should one be looking at? Because I'll look at it from an investor on the consumer side and perhaps someone else that is providing, investment or access to the capital that will be used to, fund the houses. I think the first thing is, from an investor side, you must understand that I like to look at rental expenses as sunk cost. And I remember when we started, our business about 4 years ago, one of the things that we quickly realized was that paying rent in Lekki Phase 1 was going to kill the business. Okay? We started a business, and we were in our first year. We had to pay about 10 million naira for rent. And 10 million naira was like, I think, 10% of our total revenue in the first year of business. And that's what we had to pay for rent. And it was clear that it was not going to be sustainable. Apart from paying the rent, we had to maintain the building, and it was not the only cost that we had, as a business and a small business that was just coming to the market. So I remember sitting down and saying, we just have to find a way to make sure that the rent we pay counts. And it's equity, So we sat down, and I was like, we're not going to pay 10 million naira and be looking for 10 million naira the next year. At the end of the day, we will either die serving the landlord, or we just had to find another way. And there are many of us that live in this market on the consumer side that it is rent that is killing us. Okay, so what are we going to do to ensure that, we have a chance at balancing our expenses and balancing our living, and have, a chance to even come out of this very well-defined poverty box that Mr. Oguniro spoke about when he was making his presentation? I think the first is find a way to ensure that the rent that you pay on an annual basis is not sunk cost. Now, I mean, it's easy for us to say that, and then it looks very exciting, like, yes, I'm just going to, pay this rent. There are a lot of other things, that come with it. There is a discipline to borrowing, right, that people need to understand. You enter into an arrangement where, you're doing a rent-to-own scheme. Please remember that if you default, you are going to lose the equity that you have created over the asset. So there is a discipline that comes to, participating in this kind of arrangement where you must ensure that you have planned, your finances in a way that allows you to be able to make those consistent and meet those obligations as and when, they fall due. I'm a lawyer, and I always say to people that as lawyers, the only thing we understand is whether you are meeting your commitment or you're not meeting your commitment. There's no sentiment. So you've paid 23 months without default, and you are in your 24th month, for instance. I don't know, how long is the payment? 3 years. Okay, so that's 36 months. So you've been consistent for 29 months, and then at the 30th month, there's a default. What happens? This lady does not know you. She's going to forget that you sat in this room and you spoke all the plenty English, and that, they were the ones that came to market you and said, buy this product. So, I mean, it's important to talk about, the discipline of entering into this commercial arrangement and understanding that there is an implication where there is a default or there is a breach. I think the other thing is that, these products allow you that flexibility to ensure that, there is value creation for you in relationship. So it's not a function of the money has gone and that's it. And remember that you also spend a lot of money maintaining these assets. Even for those of us that pay rent, if something goes wrong, in the house, you're going to spend some of your income, and you are creating value for the owner of the property. So if you are doing a rent-to-own arrangement, what that means is that any spend is value creation for yourself, ultimately, right? So now going to the investor side, I think that that's where this product has not been very attractive, because fundamentally we find ourselves in a market where, you have extended credit to someone, a consumer, and then when there's a default, you're going to spend God knows how long trying to get that person out of the asset, and then to move the asset to another person where you can continue to create value. So we have a significant problem with foreclosure, and this is one of the things that has made, rent-to-own arrangements very difficult, because people don't remember that where there's a default, the person that has provided the capital needs to quickly fix that problem. Otherwise, they run into significant issues because they have, a capital structure that they're working with. So we've seen that ultimately, because there is a lack of discipline in the market, because the legal system enables, defaulters, many times it's hard to see these things, pan out, over time. And I'm happy that, when you were speaking about your structure, you mentioned that, there's a 3 years, payment timeline. And I imagine that the expectation is that people can then, use that time to refinance or find some other kind of funding arrangement that takes Mixta out and then allows them to continue with other providers of capital. I think that's how I would say I read the market.
Hello. Sorry about that. Thank you very much, Tosin, and you really touched on quite a lot that even myself, I had to jot down some things. You talked about store value and value creation, and that leads me to my next question to Rolake. Not to flog inflation lots, but how best can you say real estate investment, particularly the rent-to-own, is a store of value given our current situation in Nigeria?
Okay, thanks very much for that question. There were actually two things I wanted to address first with regards to Tosin's very pertinent comments. The first one was really around seeing your rental as a sunk cost. I think part of the rationale going into this scheme is the idea that most people who come into this scheme ultimately should be aspiring towards conversion at the end of the day, because that is what ensures that the money you're spending doesn't become a sunk cost. Around the issue of foreclosures and rental payments, I think one of the things that we've tried to do as a developer is to, notwithstanding the legal challenges, as we know, we live in a market that is heavily skewed towards the tenants, when it comes to the courts. But one of the things that we've tried to do is to create a facility management structure that gives the developer some leverage around access. Of course, that wouldn't be in violation of tenancy agreements or how we adhere to the law. But I think this is one of the risk mitigation mechanisms we're trying to do to adapt to the reality of our market from a legal perspective. So there are ways both as a developer and as a renter that hopefully your interests and your rights can be protected. On the issue of rent to own as a store of value, I think it goes beyond rent to own. If you look at the real estate industry broadly, notwithstanding the current economic cycle we be, in the long run, we've seen the seasonal cycle of inflationary trends. It's a store of value because ultimately at some point in that future, you can liquidate that asset. And particularly where you can put it on the rental market, I think it creates huge opportunities for you. Interestingly, we've developed this product in such a way that allows the renter to arbitrage. What does that mean? You can actually sublet the unit. And one of the reasons we've done that is because we realize that a lot of people who are overseas, who are not able to actually occupy those homes, will be able to rent it out or sublet it to other tenants. So I think no one is under the illusion that real estate isn't a store of value. I think if you're used to operating in a highly volatile market like Nigeria, you obviously realize that when it comes to owning a physical asset and the diversity of what you can actually do to monetize that asset in the future, then yes, I see it as a store of value. Now, people often argue, well, it's a Naira investment. And if I decide I want to liquidate that asset in the near term, what is the value of that Naira vis-a-vis FX? But I think anybody who has experience in investing in real estate, if you're a serious-minded investor, you probably take a portfolio approach to your investments. There are probably a few other asset classes in there. So it's both a balancing game as well as a realization that this is a long-term investment. And as we come out of the economic downturn, there will be opportunities to really benefit from that asset as a store value. Thank you.
Thank you, Rolake. Okay, I would want to move down to, say, Babatope, to speak about the mortgage markets this time. How best do you describe the impact of Nigeria's macroeconomy on the mortgage markets? Yes.
Okay, thank you. The wider economy, when you look at the general income levels, the inflation rates, which has been hammered on today, the general level of interest rates, all of those haven't helped the mortgage market so much. You expect that, okay, with 200 million people needing homes, our mortgage sector should be much larger than this. But of course, all those plagues are out there from the macroeconomic level. Outside that, there are other things as well that one also needs to pay attention to. So there is also okay, fine, if this is the bracket that people can actually purchase or they can afford, do we have sufficient supply of homes within that particular bracket? That's also a different question as well. So all of those things are in there that impacts the size of our mortgage. I'm a die-hard optimist, and what I see when I look at what's happening around now, I like to talk about today going forward rather than so much about what all of us know about the history. There are real-life things that are already happening in our markets that have the potential of switching mortgages going forward. I think when the keynote speaker spoke, he mentioned the impact of the pension RSA, where people can draw up to 25% of their equity. So imagine somebody who has been saving for the past 7 years because he wants to buy a home, now can add that to whatever he has saved up to date, and then instantly the amount he has available for his equity contribution is a different amount. So that's that. One can say it's not enough, but I think when you take the first step, let's see how far this goes. It's easier to say, okay, fine, we've done this. Maybe it makes sense to then take more. So there is that. Another thing that is required to help the mortgage industry go up is banks have some appetite for mortgages. The bank where I work as well has some appetite for mortgages. But ultimately, banks are financed from deposit funding. So banks ultimately, even though they are giving a 15-year mortgage, they will be helped if there is a versatile or a active refinancing market. And I'm aware that a number of activities are happening to improve that refinancing system. So there is the one from the NMRC. There is, I think when you mentioned as well, let's have a refinancing market through the capital market that ultimately layers this thing. So all of those, they won't happen overnight, but they are in the offing. So, there is potential for, in the long term, for mortgages to still come up. I think mortgages ultimately will come up. Ultimately, the market ultimately needs mortgages. But key, that doesn't take away from the impact of the macros anyway. It is one thing for the banks and co to have appetite. At the end of the day, do people have the income levels, less their compulsory, what they call it now, the non-discretionary expenditures? Do they have sufficient discretionary cash flows to ultimately be able to sign up to a mortgage? So all of those ultimately will be required. But I think while those macroeconomics are in there, there is opportunity for mortgage ultimately to come up. Things are happening, and I think one should just be careful to plug in as they come along. Thank you.
All right, thank you so much, Papa Tokwe. To build on what the things you said, you talked about the refinancing structure. My next question will be to Dapo. It says, given the situation of countries, the rising cost in real estate, would you classify the 15 million NHF loan as, what would you classify it basically? What would you classify it as?
I think, first of all, you have to look at why the NHF was set up, right? It was set up for lower to middle income earners to be able to build and own their own homes, right? And if you look at the performance of the NHF, especially in the last 7 years, you'd see that they've been able to disburse more loans in the last 7 years compared to the years before that. And they've actually introduced some new initiatives that has led to an increase to the number of subscribers, which makes me very excited to see how Duo will turn out. Because, of course, the NHF introduced a rent-to-own initiative, and I think it's about 7%, and that increased their number of subscribers by about 900,000 within that same period. Now, looking at the amount being disbursed, we have to put into cognizance that construction costs have increased as at August. It increased about 34.5% year on year, and it's probably a whole lot more in other areas in Nigeria. So by the time you put that in cognizance, you'd see that it might be perhaps a little bit insufficient. Because remember, if you are subscribed to the NHF, you don't get 15 million. You get up to 50 million. So that means that the chances are you don't actually get sufficient money to, to construct your home. So I think with rising inflation, macroeconomic problems we've been having, the rise in construction costs, because of course most of our construction materials are being imported to the country, so it's a whole mess. But what we can begin to push for as market players, as market participants, is for a policy review, especially for the NHF. You understand? Because it needs to, the amount needs to, it needs to mirror the current realities, right? While we are having a lot of people subscribe to the NHF, more people are getting mortgages. I think right now we have about just 1% of the population that have access to mortgages. Imagine if a whole lot more people can have access to mortgage to get homes they need, and have a much more efficient credit system. That would go a long way. But right now, I'd say it's insufficient and needs a policy review.
Thank you for that, and thank you for citing the increase in their disbursements in the past 7 years. I'm sure Mixta was a major contributor to that as well. And to build on policy reviews, my next question will be to Tosin. I'll talk about the recently approved real estate funding by PENCOM, that's the RSA. How practically do you think it is, given this time? Or how practical is it?
Thank you for the question. I think that for me, it's something that I find very interesting because, and I have a very strong view about this. I don't even know whether to talk about these kind of things in this kind of forum. So I've always been a believer that if our pension contributions is not, impacting our lives while we are still very active and agile, then there's no point. So for a long time, I'd always been an advocate for, pension funds should be directed at projects, and the capital should go in the direction of the things that have the capacity to impact the lives of the majority of the people. And we haven't really seen much of that in the whatever number of years that the act has been running and people have been making, contributions to their RSA accounts. I don't want to be 65 and then get a paltry whatever I've contributed for, the number of years that I've worked, perhaps 3 decades or more, because, you know what the value of that fund is. They're not matching inflation or anything. So I've worked for 25 to 35 years, and at the end of the day, I'm going to get, a pool of funds that is not worth much as at the time that that money is being given to me. So the real value in, the funds is how it is being channeled in a way that impacts my life while I'm still in my active years. A lot of people have spoken about the fact that government is outborrowing all of us, and they are the biggest beneficiaries of the funds. And what are they using it for? A lot of times they're using it to cover, recurrent expenses. So this for me is a very, very, very impressive and important policy direction. So what that means is that I can use my money while I still can, right? Be it 25%, but what it means is that I can have direct benefit from these ballooning pension funds and be able to say that, yes, there is some value, right? So I think it's very great. And, reading the guidelines that came out in September, one of the things that I found to be, the most impressive is that apart from the fact that you can immediately access 25% of, the monies in your RSA funds, it's also gone ahead to think of how to help people resolve issues of, default, right? So, for instance, there's a provision in the guidelines that says that in the event of a loss of job, after you've accessed, credit to buy a home, you can even access a further 25% to deal with those kinds of situations. And I find it to be, very, very, impressive that, the Pension Commission is thinking, more about the contributors than the people who are accessing the capital, because, frankly, we need to ensure that we do much more of what makes those of us that are making pension contributions feel the impact of it, in our very active years.
Thank you very much, Tosin. You would appreciate the way a lawyer talks about the value in the policies that have been listed out. I'm certain that if I had read it all through, I would actually be looking at what exactly is the benefit other than 25% access. But thank you for that contribution. Next would be Rolake. Building on the value she had mentioned, I know it has been flogged, the rent-to-own scheme. Kindly just highlight what are the benefits, what exactly you see about the rent-to-own scheme in Nigeria, looking at Lagos State as a background and other companies that have tried the scheme.
Okay, yeah, so I think one of the things I wanted to say overarching the entire discussion is that we need the different parts of the ecosystem to be working. The reality is that rent-to-own schemes will only be successful to the extent that mortgages are available. So it's not really an alternative per se, it's a complement, because at the end of the day, part of the exit strategy from a rent-own scheme could be a mortgage. And part of what we are taking into account now is who are the kinds of subscribers that would potentially qualify for a mortgage. That is part of the filter and the lens through which we sort of assess the credit worthiness of a rent-to-own client ultimately. Because, in advanced markets, rent-to-own schemes sometimes are up to 7-10 years. And so there will always be a small pool of people who may not have built up enough equity after 3 years, but may have enough equity to go into a mortgage scheme. So you still want the mortgage market to work. And the mortgage market then has to work in a system that promotes economic stability. And the reason I say so we often point to the 1% mortgage to GDP ratio, But part of the challenge we had with the global financial crisis in 2008, we had all these economies that were hugely, the ratio was much higher. And if you look at the credit risk in the system, it was a natural instability mechanism. So actually, there's a bit of a double-edged sword to having a very strong credit market, because in an economic downturn, those particular assets that are being created then could be at risk. But nonetheless, we need to ensure that all the parts of the industry are working in tandem. In terms of the rent-to-own scheme and what are the benefits, well, Goyinde, you already highlighted that in your presentation, but I think the low entry point, I think, is key. When we talk to our customers, a lot of them are often surprised, only 5% down payment. And if you look at what is happening in the markets, if you look at markets like the UK or the US, you pay your rent on a monthly basis. So as long as you have a stable income, an assessment is made about your ability to afford regular monthly payments. The challenge is not many people can just find that initial 1 million upfront to put down. But if they're in full-time paying employment, then on a monthly basis, they actually have a reasonably good credit profile. So I think what this really allows people to do is those who otherwise would not have been able to access can come in at a low entry point. And then the other thing is there is something, I guess, maybe emotionally gratifying about rising gradually onto the housing ladder. And I think it actually sets a really good precedent psychologically that I've worked for this, I've seen my income grow over time, I'm contributing, and essentially Mixta is providing a savings option. So we're actually, in another sense, providing a savings scheme for those who want to save and contribute over time to the market. And then the third element is really from an economic perspective, which should not be overlooked. I think often as private sector developers, we may underrate the extent to which we're a key driver of sustainable economic growth. And you know, when we're looking now, people talk about the double bottom line. There's even now the triple bottom line. And I think the housing ecosystem is such a major driver of economic activity that by the time you plug in a rent-to-own product into a market, and you look at the entire value chain of services from construction, manufacturing, interior, facilities management, payment system, online payment system, what you're doing essentially is creating jobs. And in that entire ecosystem, there will be new service providers. So you'll see new SMEs come up to offer services. So it really is about economic empowerment. And I think that's something that shouldn't be overlooked. And it's part of the core selling message. When we speak to a lot of our diaspora clients overseas, you know, something about investing at home pulls on your heartstrings. And to be able to tell them the narrative that I actually contributed to sustainable economic development in my home country, and then it provides a reasonable return and rental yield over time. I think that's a great story to tell, and I think beyond the practicalities and financial benefits, it's really key. And then the final thing I will say, at the end of the day, Mixta isn't a charity. If you look at how we've designed the scheme, it's actually meant to deliver returns to us as a developer. And why is that important? Because it's a signaling element to the rest of the market. What we've done is, should you, in the unlikely scenario, choose that you're going to walk away from the asset because after 3 years you can't get on a mortgage scheme, we're able as a developer to put that asset back into a pool for another rent-to-own cycle, or we can sell the home, which is now a finished home, by the way, not an off-plan home, on the open market. So I think the benefits are evident. Some are a bit more nuanced, but I hope you know that sort of gives you an idea of the benefits of this whole scheme. Thank you.
Thank you very much, Rolake. Thank you, listeners. I'm sure you've enjoyed most of the discussions from the panelists. In case you have questions, please write them down, or once we get our last notes from the panelists, we'll be able to take them. Just in simple forms, now we're rounding off, don't worry, we're leaving the state very soon. In simple forms, can you give your closing remarks on this short thing? Is it a good time for real estate investments, in your view?
I think my views are already known. I think it's an excellent time for anyone to pay attention to real estate. Are there things to carefully think about, to carefully consider and mention? Yes. But is it the best time to make, if you listen to the best investors in the world, the Warren Buffetts and the likes, it's time of uncertainty. That's when they say be hungry. When is it what's the word now? When everybody is shy, that's when you should be aggressive when everybody is shy. It looks as though yes, there's a lot of issues around now, but I think it's an excellent time, it's an excellent opportunity. Home ownership, other forms of real estate, an excellent opportunity to take a look at it. Yes, thank you.
Thank you. Okay, I think that there's no bad real estate investment. That's what I would say, provided that you have you understand, the nuances of the investment, and you take all the necessary precaution in making the investment. But there is no bad real estate investment, and whatever level you are able to play at, based on where you are at the moment, please seize the opportunity and get on the investment ladder. That's what I would say. Thank you.
Thank you.
Okay, I think I'm just going to echo what the other speaker said. Yeah, this is the best time to, go into real estate. And now it has been made easier through, initiatives, stuff like rent to own, real estate fractionalization, tokenization, etc. It's getting much more easier to own homes and still get returns. So, I mean, there hasn't been a better time to invest in real estate, but like we just heard, it's best to do as much research as possible, speak to the right real estate professionals, do your own research, find out where the highest yields are, and just make sure you're not being, you're making the best decision and not just being pushed by greed. Yeah.
Thank you so much. Thank you so much, our panelists. And yes, just like you mentioned, it says speak to the right real estate professionals. Mixta Africa, speak to us. Thank you very much. Does anybody have any question, please? Yes.
Good afternoon, everyone.
Good afternoon.
My name is Stephen. My question is to Ms. Rolake. We all understand that there's expansion in the real estate industry, and there are a lot of property developers and real estate firms coming on board. I've noticed that the major focus or interest are in the residential real estate. So my question is, what is the hope for commercial real estate, considering that when these residential spaces are now occupied, people need places to lounge, leisure, and other stuff. And by commercial real estate, I would like to place emphasis on the hospitality industry.
There may be other people better placed. I know you finance commercial real estate, right? So you may want to make some contributions. And we have Mrs. Hughes, who is a veteran in the hospitality space. I'm sure she'll have a few things to add. I think the big turning point for the sector was really at the height of COVID. And it's not even just a phenomenon that's unique to the Nigerian market. I think you saw a huge drive towards staycations, and a lot of developers that perhaps didn't even consider that market were now looking into that space. And I'm a real believer in rental opportunities in the hospitality space in terms of the potential yields. So I think it's going to continue to be robust. I think we saw a huge downturn in commercial real estate in the immediate aftermath of COVID, but it's actually picked up. So what a lot more developers are looking at is sort of bringing back mixed-use developments that combine a bit of both, this idea that you can live, work, and play within the same space. So I think it's a potentially thriving market. Mixta has a very unique model that it sort of implements through Lakaway Lakes Hospitality Limited. So, I mean, that's my perspective. On the developer side, as to whether one should invest and build actual physical hospitality assets, I think that depends on so many other issues that, I can cover here. But that would be my perspective. I don't know whether Baba Topwe or Mrs. Hughes.
Thank you. Not much to add. I think you really spoke to it quite nicely. Just from COVID, as you mentioned, what we see, because we see commercial, as I said, whether it's retail malls, whether it's offices, hospitality. What we have seen since advent of COVID since the end of COVID is this rapid recovery across commercial real estate properties. So it gives a sense that it's also a resilient sector of the real estate. Just as you mentioned, you hardly can make a very bad real estate investment. But if you are going into hospitality, then you then need to be careful around what are the things that drive hospitality. Are you building for the area? Are you building for the location? Are you building for the target demand? Where's the target demand there, and this kind of stuff? And then of course there will be the extra issues around are you going to get, are you sourcing funding, because the funding characteristics for the different segments will be different. The lender appetites to residencies is different from lender appetite generally to retail malls, different from lender appetite generally to an outright hospitality project. So all of those things then to be, you will find that if you are going to be doing hospitality, it will be demanding on the equity side. There will be a lot more demand on equity contribution from my own perspective. So, so all of those you will then need to put into consideration. Is it an outright bad opportunity? As residentials come up, it is population and people movements that will drive the demand for hospitality. As more people live in a particular area, they will ultimately demand for areas where they can relax. So, and I think that's the idea behind the work play, because if people are going to be living here, they will need somewhere to play. So all of those things, I think one can think about as you crystallize your ideas around a commercial opportunity.
Thank you. Thank you. Any other question, please? Yes. Okay. Sorry about that.
Yeah, I'm just going to contribute to my own, just to add to Rolake and the gentleman as well. I think that, there's something to be said for the way that the world and Nigerians are not exempt post-COVID. In terms of alternative real estate investments, we're focusing on residential here today, but we can't but touch on other sectors. The commercial real estate, for instance, there's the emergence of co-working spaces. Interesting, very, very interesting. In terms of even hospitality, when we talk about hospitality, we tend to sort of think mostly about just hotels and things like that, but there's also the leisure part of it. I think COVID has really brought that to the fore. I think that, and then another subsection of that, also pertaining to lifestyle, is the emergence of things like restaurants, restaurants and that kind of, real estate, that kind of products as well. It's a huge industry. There's a lot of, and then I don't know whether there's just like a renewed zest for life. And let me just focus on Nigerians. I think Nigerians work really hard, but I think Nigerians know really how to play really hard as well. So, there's also all sorts of things that speak, all sorts of, subsections of real estate that also speak to this kind of lifestyle.
Thank you. We have one question from the lady in black.
Thank you. Good afternoon. My name is Boladale. My question actually borders around the exit matrix for the dual product, basically. So where someone has taken on, registered with you, or taken off the dual product, and at the end of 3 years is unable to get a mortgage, for instance, or intends to pull out, understanding that what makes up the contribution is the rental amount for each year and 5% of the value of the property. So what is the matrix? What is the formula for pulling out or for coming out of, the agreement that's been signed with?
Okay, so I think several things to say. The first thing is that 3 3 years is a maximum period. So you can actually start your conversion, opt to convert from the end of year 1. So you don't have to wait 3 years. If your financial prospects suddenly improve, you can decide now you have a lot more money, or you can even start the mortgage application process early. When you rent a house, normally, the landlord doesn't give you a refund at the end of rental period. They may refund your security deposit against damages, but they won't refund your rent. And I think that same concept applies here. So part of what you enter into is an agreement that should you decide to walk away for whatever reason, and there are different reasons why people may not be able to convert to ownership, you don't get refunded. And that's not necessarily a bad thing, because psychologically, if I've been essentially investing in a house installmentally, I want to do all within my power to ensure that at the end of a period, I can own the house. So the exit formula is, in the event that you're converting, it is essentially the price of the home, the value of the home at that point in the future, less your equity and your annual rental payments times an interest rate element. Of course, it can be just less all the payments because of the time value of money. And that's something we make known upfront to our consumers. But the reality is, even considering the interest element, it is still a competitive price at exit compared to what the actual full home value would be at that point in the future. And that is in the event that you exit into ownership. Now, if you exit the scheme completely, you only get refunded any amounts you've paid over and above the minimum annual requirement. Assuming the minimum annual requirement for rent is 1 million, and you've topped up, and essentially in your credit, so to speak, you have times X, you only get that X refunded at the end of the conversion period. That is the exit options. And one of the things that we want to look to do is to actually help our customers with how they can obtain a mortgage. I had mentioned that part of what we look at is your mortgageability, if you like, your credit worthiness from day one.
Thank you very much. Well put. Any other questions, please? Okay. We have 2 hands. Yes.
Hello everyone, I'm Deborah, and my question goes thus. Apart from the risk of default to the customer, like the fact that if you default, you forfeit the equity payments, are there any other risks for the customer, the consumer? That's my question.
I'm sure maybe even Tosin can take this on more from a generic legal perspective, but I think the risk is the risk of default comes with all types of other risks, like, going to court, trying to negotiate an exit and all of that. But I think there's a psychological risk, if I may, is, the risk of, there's no risk. You risk capital to go into real estate with the hope that you'll get a return. So it's a risk return, it's a calculated risk, essentially. That's what it is. But I don't know whether you foresee any.
It's interesting that you ask. I think she's going to sign up before the end of the day, and she wants to get some free legal advice before she does that. So I think there could be product risk. So the quality of the asset is a potential risk, depending on the kind of party or developer that you're dealing with, obviously. So that could be one. Title risk. You need to be sure that whoever is bringing this product to market even has title over what they're giving you, because if there's a deficiency in the title of the developer or the owner, then you are buying future litigation, and you're clearly going to lose, money down the line. So you would take precaution as though you're doing any other kind of real property investment, because the principle in real estate investing is that it is you who's buying or making the investment that has the onus to take caution. So there could be title, products, and any other kind of risk that could, potentially apply when you're making any real estate investment will be, things that you also need to look out for. But this is Mixta.
So I guess you can rest assured that some of those things are already taken care of.
Okay, thank you very much. My name is Chukebuka. So, Dikocha, I just want to ask, do you people also have properties like this outside Lagos, like in other states? Because I stay in Port Harcourt. So I wanted to know, especially the hospitality sector. So let's say if you go to in Port Harcourt now. Also, I wanted to ask, what plan do you people have or partnership do you people have with the government, if there's any or you think there will be any, to drive this in cases, for example, let's say if the government now should open the port in Port Harcourt, you know what that would mean? The inflow of people, like she said, the hospitality sector is driven by people. So where there are people, they'll look for places to, have fun and do this. So if the government should try to do that now, open the ports, it will cause a huge inflow of people to that particular area, and which can, support this hospitality project if you have one there. So I just want to do that.
Okay. Yeah, I'm going to let Mrs. Hughes take this.
Your question is very specific to a certain location. I don't want to. I mean, I could go down in history to talk about our hospitality investments. The first 4 Points by Sheraton Hotel in Africa, and some other things that we've done. So we, in the fullness of time. But let's not lose focus on the fact that we are a real estate company. And that is the topic for today. So we can. I mean, it's a welcome comment, and I think I'd like to leave it at that for now. I don't know if I probably haven't answered your question in full, but yeah, I'll just stop there. Yeah, thank you.
Oh, thank you very much. I can't see any hands up anymore. Okay, one more, last person.
Good afternoon, everyone. Has the project actually started, and are there opportunities for viewing to actually go there and see where it's actually located?
Hello. Yes, the project has actually started. We have promised an 18-month delivery timeline. So depending on who your RM is, yes, you can be taken to site. As you know, it's a large-scale development. There's actually a model at the back of the room. And because we're building in blocks, the project planning has to take into account, a sort of phased and sequential delivery of the unit. So yes, the project has indeed started. And in fact, when you go to site, you will see a board that gives you an estimated project delivery timeline. So we have to deliver to time because, you have to take rental of the product. At the time that we've said you will take rental of the product. Yeah. I think there's a gentleman behind you.
Sorry, I have a question.
Okay, can you read it out?
So the question says, would you say the value of the houses in Nigeria are overpriced? When looked at year on year, the price increase is sometimes 100%.
Would any of you want to take it? Okay. Apple.
Okay. I think I have to disagree with that. You'd hardly see any property that appreciates 100% in a year. While yes, property appreciates over time, it's a whole lot more measured. Well, except your currency is sinking. I know the naira is getting devalued every other time, but at no time will you see that kind of dramatic appreciation. Even if the house is in one remote area and they just build a connecting road, it won't just have a very large boost like that anywhere in the country. Yeah.
Thank you.
Okay. Hi. Good afternoon, everyone. My name is Shegun. I just want to ask a quick question, Olusegun. Thank you. So I just wanted to ask, maybe I should even be directing this to the Duo team, because I came in a bit late. So are there restrictions to the rent to own? So for example, for retail investors, maybe an individual who wants to just, pick up a couple of units, then probably for investment, not necessarily stay there, stuff like that. I know it's called rent to own and all that, but the idea is probably used for short lets or other things. I've seen in some other locations where the government actually has restrictions, or maybe people have restrictions on how you can actually use that property. But talking to the Duo team, how can you guide and help retail investors, young people who just want to probably, they'll still make their decision whether to stay there or not, but with time, they want to have that flexibility of saying, I need to be able to have a bit of control over this property to how I want to use it in my portfolio. Then I'm assuming you also handle all the facility management and everything that goes with that. So that's my question. I don't know if that's clear.
Yes, it is. Okay. I'll just answer that as the product manager of Duo. Thank you for that question. I would say the only restriction that we have right now is an individual can only own one unit, because it's a rent-to-own scheme, the pilot phase, and we want as many people as possible to be able to come into the scheme. While you can own the property, you can decide to use the property as an investment tool. You can put it up as rent to other people and gain certain returns on it. You can use it as shortlets for your the maximum number of rental period, that's 3 years. But at the end of the day, you would be renting from Mixta Africa with the option to either buy or let go of the rent-to-own scheme after 3 years. Then yes, there are also responsibilities around paying the service charge for the facility management. In as much as yes, the company is going to provide 24/7 facility and adequate infrastructural services, the onus is on the homeowner to actually pay for those services. Yes, then aside from that, I don't think if you say the restrictions around building maybe like small sheds internally or externally, for the rental period, that is not allowed. You're not allowed to make structural changes to the building. And I think that covers the entire restriction on Duo product itself. Thank you. Okay. Rolake.
So the stance we're approaching is that we also will be looking to adopt a more flexible approach to the scheme in the future, because we've had this question from several people who are investment minded and see an opportunity to own a portfolio of rent-to-own homes. So maybe in a few months we might reconsider the approach, but because it's a pilot and there's a sort of impact element to what we're trying to do, hence the restriction. However, that should not stop you from engaging with us. So if you see an opportunity and we think it makes sense, nothing is off the table.
Okay. I'll say that's a wrap on the panel session. Thank you so much, our panelists, for joining us and for answering our questions. We really appreciate you. Yes. Yes, please. Can we have a picture, please?
Yes, the photograph is coming.
I would like to invite the CEO of ARM in person of Jumoke Ogudare, and also the CEO of Mixta Africa in person of Deji Ali, as well as the MD of Mixta Nigeria, Shadi Hoods. Thank you.
Thank you very much.
That was an interesting and insightful panel. I hope that we've all learned a thing or two. We're really behind schedule, and I would like for us to finish in time. So next on the list is that we have a remark from our affordable housing expert, Mr. Olu Olanrewaju. He's unavailable physically, but he's going to join us via Zoom on the screen. While we work on that, I'm just going to read a brief bio. Mr. Olu Olanrewaju is a leading is a member of the Royal Institution of Chartered Surveyors with an MBA. He has a wealth of experience in both the development and management of affordable and market sale housing in the United Kingdom and across the globe. He is also a co-founder of a startup affordable housing company providing climate-smart affordable homes in Nigeria. Okay. Good afternoon, Mr. Olu. Thank you for joining us today. Can you hear me? Good afternoon. Great. Thank you so much for joining us. We'll be taking your remarks now.
Okay.
Great.
Good afternoon, everyone. Thanks for the invite. To demonstrate that rate of urbanization in terms of in the context of Africa. But to share some of the statistics with you, in 1950, the world's population was about 2.5 billion. Out of that 2.5 billion, 9% of that were people living in Africa, which was roughly about 230 million. As of 2015, the world's population has grown to 1.2 billion. And out of that, Africa as a continent, the population has increased by 16%. And I'm sure you can imagine Nigeria's contribution to that. The current projection from the World Bank is that by 2050, there will be 9.5 billion people living in the world. And again, Africa will have about 2.4 billion people living there, which is roughly about 25%. Then if you project it further, by 2000, there will be expectation that the world's population by 4.2 billion, and Africa will be about 40%. So it tells you that actually the discussions you're having today or the issues we're looking at today, it's one of potential serious challenges for Nigeria's economy, both in terms of infrastructure implication, both in terms of social implications, the likelihood of upheaval if people are not living in good quality accommodation. And I'll just give you a quick insight. The Egyptian government has invested over I think they've borrowed over $1 billion from the World Bank to address the housing crisis they're facing. Why? Because they saw a direct correlation between the Arab crisis that happened about 10 years ago. I can't remember the specific time, but they saw that there were a lot of people living in poor housing conditions that had no stake in the society, and they felt that the government had to step in. If not, they see ongoing troubles. And I'm not saying that's the case in Nigeria, but surely I think we're all intelligent enough to see that if people continue to live in poor quality accommodation, if they're having poor quality outcomes in terms of education and health, that is not a panacea for a stable environment. So that's why the whole issue about housing crisis that we face in Nigeria needs to be addressed at a point in time. The current projections is also that Africa will be housing 7 out of 20 world's biggest cities in the next 50 years. And Lagos is going to be one of those mega cities, as they're called, that is projected in the next 5 years. Now, the question we ask ourselves is that is Lagos State or any part of Nigeria prepared for that exponential growth in terms of the expansion of our cities? So it brings back the point that housing, as not only in terms of the benefit it offers to the population at large, cannot be ignored, but also the wider economic benefits, some of which I will cover shortly. Well, but also, whilst the housing demand, or I would actually prefer to call it the housing need in Nigeria, is growing, it's important to mention that actually we lack effective demand. And I'm sure some of the earlier speakers will have spoken about the lack of access to mortgage. I think the mortgage GDP ratio in Nigeria is less than 2 or 3%, if not lower than that. If you compare it to matured economies in the UK, currently the GDP mortgage ratio is about 67 to 70%. In the United States, it's over 80%. So quite clearly, you can see significantly that the absence of housing finance in form of mortgage is currently a constraint of translating that increasing housing need to what I call effective demand. And I don't want to even talk about how expensive the mortgage interest rates are currently in Nigeria. Although having said that, people, some of us that live in the UK or in the US, we also need to be humble about that because of increasing mortgage interest rates now we face as well. But nonetheless, the double-digit interest rates that is currently people experience in Nigeria is definitely not affordable. It's about 4 or 5 years ago when my firm was playing a critical role in setting up the new institution, family owns funds. One of the areas we looked at was whether it is possible to blend government's cheap money with commercial rates in order to create what we call then help to buy. I'm hoping that family-owned funds, I know they've raised some further funds from the African Development Bank in order to expand that product. We see that addressing the lack of mortgage facilities in Nigeria has to be one of the solutions in addressing the current ecosystem that is not functioning properly. So, moving on to what are the benefits of affordable housing? I don't have any, there's no point in overstressing the point. It's quite clear it has a significant impact on economic growth. As you well know, investment in housing provides employment, both in terms of job opportunities during the construction period. If you can create a second-hand market where people are buying or selling houses, there's also an opportunity to create in terms of maintenance, in terms of refurbishment. So the average sort of data that is shared in the international development world is that actually a new home creates about 4 to 5 new jobs. In a country like Nigeria, where unemployment is high, you can imagine the benefit if we had a significant boost in the construction of residential good quality homes. With new homes, people purchase goods, they buy new fridges, they buy new beds, they buy new furnishings. So you can see the sort of supply chain implications of provision of housing. Also, it leads to increased production. There's a sort of supply chain in terms of people providing doors and all the other supply that comes with a significant boost in housing supply for local businesses. Then also, it helps in terms of greater pension contribution and taxable income. If we have a good system that is functioning in terms of land titling, it could also lead to local taxes being increased, because if people can get land title cheaply and faster, then that also can lead to greater contributions in terms of local taxes to the local state government as well. So in every society I know that is functioning properly, owning homes, renting homes is seen as added value. And also, apart from the other thing, is that it also helps in terms of generational wealth, because people have an asset that they can securitize in order to generate income, more income or cheap finance, and also could also be able to hand over assets to their children as well. So I mean, the other benefits also include in terms of health and education. If people are living in good quality homes, they're healthier. In terms of education, kids can do their own work in good environment. So the multiple effects, and I think in terms of the Sustainable Development Goals, the UN sees housing as one of those activities that takes all the bulk of the sustainable, I think the 12 or 13 Sustainable Development Goals. So I can't underestimate how crucial housing production in significant scale is important in terms of the economic performance or economic outlook of any country. So moving swiftly, because I'm conscious of time, I think you gave me 15 minutes to talk, is the product which you're launching today, and I commend Mixter for bringing this product to the Nigerian sector in a formal way. I do know that rent to own in some form or the other is always been around in the Nigerian context, but I think this is probably the first time I'm seeing a well thought out approach or well designed approach in order to promote rent to own. I've had many years of operating, designing rent to own designing rent to own product in across the world, and have significant and do recognize that it's a product that is not always easy to execute properly. It's got its strengths and it's got its weaknesses. So if I just move to some very basic points about rent to own, which I'm sure you've all explored or you must have touched upon earlier. Generally, I think it's always worth mentioning that there are broadly three types of rent to own. And we need to be careful that sometimes the product I see in Nigeria or other parts of Africa are actually a form of what I call informal credit agreement between a developer and a purchaser. They're not technically rent to own. They're just a form of payment plan. Definitely the Mixter product is totally different from that. The reason I say that is that a traditional rent to own, there are about three elements to it. You have a situation where the developer builds the homes, then you have like an investor, because there must always be somebody that have got access to patient capital. Now, in this case, it might be the developer or there may be a financial institution that sits behind it all. The homes are let on a rental contract. And I think it's important to understand that when you call it rent to own, there is always need to be a tenancy contract that sits there because it's still a rental scheme. Now, in some arrangements, options that there is an option to purchase at the end of that rental term. In some cases, there are arrangements whereby people are setting aside some bits of money so it could be an escrow account or whatever arrangement, so that over time they save enough to purchase the homes. Now, it becomes tricky in Nigerian and African context, especially when mortgages are not available. And that's why the exit is crucial. It's crucial. So the purchaser needs to be extremely clear around how are they going to exercise the option to purchase. Because, as I said earlier, the challenges we've had about financing of homes in Nigeria and in the African context, that absence of patient capital makes it more tricky. If I recall, I've not checked the mixed product in detail. I think it's about 3 years or 4 years for people to pay. I can't remember specifically. In a typical rent-to-own, it's usually more, the length of term is usually more than that. But I can understand in the context of Nigeria, where patient capital is lacking, it then makes it more difficult for people to exercise that option. Or not that it makes it more difficult, it becomes more pertinent for the potential purchasers to be extremely clear around how they're going to exit or exercise their option to purchase, because the mortgage system is not sophisticated enough. So there must be either sources of financing that people need to rely upon and be sure they're going to get the money to exit, or else they have the potential problem of defaulting. The other form of rent-to-own, which is probably more pertinent in the UK and the US, is one whereby people are purchasing equity, whereby they're purchasing equity from the word go. So you probably purchase an equity of maybe 25% of the value of the property at the beginning, and then you incrementally buy equity as you go along. Now, the common theme, because of the financial situation in some of these countries, is that there's a longer term. So it's not unknown for the length of term to be 10, 15 years. But I've not seen anywhere, maybe apart from South Africa, where the length of term in Africa is more than 5 years. So I will suggest that it's something that it's actually necessary, it's important, but if as the lawyer says, caveat emptor, buyer beware, in terms of before you commit to rent-to-own. So what are the challenges of rent-to-own? If it's set up properly, some of the challenges include maintenance charges, who's responsible for maintenance, the process of buying up, if it's what we call shared ownership, can be quite expensive. It's also the restrictions. People need to know that even though you're paying part of the equity, the restrictions you have, there could be until you own the property. But there's some constraint, because if you don't pay, eventually the investor or developer, they want the property back. So there are inevitably going to be some constraints around that. Regular additional payments, if it's not held in trust, could disappear if the developer goes bankrupt. But our advice when we're setting up this is that the savings element should be in the form of escrow. Again, the risk that mortgage finance is a problem should be taken into account. So I will say that, just to finalize my quick talk, the preconditions to success after running these schemes for so many years is that you need a source of long-term finance, of patient capital. You need an effective legal system to enforce the tenancy contracts. You need a proper management and maintenance operation for the rental arrangement. You need good supply of affordable housing, clarity of roles and responsibility of both parties, clear consumer awareness of their rights and obligation, a regulatory system where possible to monitor providers, financial options for renters to exercise their purchase options, a robust financial modeling, a robust plan in terms of scaling it up, because I've seen a number of initiatives that start but ended up not being scaled up because proper financial planning is not being in place. Apologies for a rushed presentation, but I will end on that note. And again, thank you for the invite, and I wish you well, Mixta Africa.
Thank you so much, Mr. Olu Olariwaju, for your remarks on the rent-to-own scheme and being an expert on that. Thank you so much. My name is Sheon Ogulano. I work with the Duo team as an operations analyst, and I would like to say a very big thank you. First of all, I'm honored to have been part of this great event, and on behalf of Mixta Real Estate, I would like to say thank you to our esteemed keynote speaker, Mr. Hakeem Oguniro. I would like to say thank you to our panelists, Mrs. Tosin Ajose, Mrs. Rolake Akikugbe Filani. I'd like to say thank you to Mr. Babatope David. I'd also like to say a big thank you to Mr. Dapo Ronshewe. Sincere thanks to the management team of Mixta Africa and the team that has been working tirelessly to make sure that this event came out and was a success. Thank you all. Lastly and finally, I would like to say thank you to our esteemed guest, our client, and our potential clients for gracing us with your presence today, for taking out time to be present and, you know, to be here with us. Thank you so much, everyone. Enjoy the rest of your day. Thank you.